Greetings. Thank you for attending the 2020 NFDA conference. Hopefully, this will be our first and last virtual annual conference. I'm Mark Ritchie, a principal at Gantry. As the largest privately held mortgage banking firm in the United States, we have a unique window into all elements of financing commercial real estate leased to the government. Over the next 2 hours, no, just kidding, maybe 10, 15 minutes or so, I am going to be sharing what is happening in the various financing sectors. That is construction, acquisition refinances, and construction to permanent financing structures. If you have attended an NFDA conference in the past, you will know I kick off the finance panel, with a little bit of fun. This year is no different. Though this seems to sum up the world in general, the finance markets are in pretty good shape. First, construction. Construction's been a real bright spot. We have seen more construction lenders finding this space. Projects fully leased to the U.S. government are extremely attractive, particularly as concerns about other tenant credit grows, that is, tenant strength earlier this year versus today. There's been a real flight to quality. If this continues, we believe the increased competition may lead to more competitive and better terms over time. What can go wrong, right? With new entrants, we are spending lots of time educating the parties. Examples include lump sum reimbursement packages, and particularly as they have grown to ameliorate scoring issues, we are educating construction lenders, appraisers, insurers on how this works. Though there's a bit of a disconnect. Many of the new entrants in the space do not appreciate that these projects trade as credit tenant deals, not as traditional office or medical office buildings. So for many of these appraisers that have not appraised credit deals, it can lead to problems. This oftentimes flows up into the credit function of a bank, where they may or may not have experience in this space. Cost containment has become a significant issue, both pre and post-award. For post-award, we are seeing bumps to TI or lump sum LSR related costs. Now timing, getting shovels in the ground. Lenders are requiring 100% approved plans and a fully entitled project to fund. This is often at odds with the GSA and VA lease requirements, even with the fast track approach being employed. Now on to acquisition and refinances. Loan to values are down. Now let me clarify. This is primarily happening in the shorter term lease space. Credit worries about commercial real estate are filtering into the government space. With COVID-19 increasing general uncertainty in the commercial real estate markets, we have seen traditional lenders lower loan to values anywhere from 5 to 10%. Meaning, if you financed a shorter term government leased asset a year ago with 70% debt, it's closer to 60, maybe 65% loan to value today. How can we counteract this? Recourse. Recourse matters. Though this is a completely different situation for firm term leases 10 years, remaining firm term leases 10 years or longer. Rates for longer term debt, say about 10 years, range from mid-twos to about 4%. Finally, here, there is an interesting push-pull dynamic between lender and borrower. Buyers' returns are getting squeezed on tighter pricing. Lenders are solving this through faster amortization. The faster amortization issue is happening in both acquisition and refinances. This dynamic ebbs and flows. Now our last topic, construction to permanent financing structures for build-to-suits. That's a mouthful. Best interest rate market ever. I repeat, best interest rate market ever. Is that too strong a statement? Will I say it again next year? Rates for combined construction to permanent loans are in the threes for up to 22-year terms. This means up to 2 years, generally up to 2 years to build the project, and lease term matching the mortgage term for the 20-year firm term deals. These one-stop lenders have been both helpful and creative with a seemingly endless change in costs and increased scope of work. They understand and appreciate how these elements impact the long-term viability of the asset. Structures have been created to allow for the developer of smaller facilities to enjoy the same benefits as the mega builders of these projects have long had. This has been a boon to our VOSB and SD-VOSB clientele. Thank you for sitting through this. If you have, I will buy you a drink of your choice at 2021's live NFDA conference. You'll have to remind me that you made it this far through this presentation. I hope you enjoy the rest of the NFDA conference. I am Mark Ritchie, signing out.